Hello. This week we will be covering chapter 6 and chapter 7 and chapter 8. Today I'm going to go over internal controls and cash. One of the things to talk about is what is internal controls and why is it so important. Many of you know that when you have your own personal bank account or your own personal finances, you need to have some manner in which to ensure that your cash, your financial resources are not stolen or made available to people without your permission. Internal controls works similar to that. It is a basis upon which we set parameters of what people can see and use and what they can't. It allows us to have some safeguards in our accounting system, particularly as it relates to cash and other assets. The Sarbanes-Oxley Act was initiated to ensure that ethics and financial accountability is exercised with public firms. Many years ago, there were some type of fraud that was perpetuated by upper management with the assistance of auditors. And the Sarbanes-Oxley Act purpose was intended to maintain some level of confidence that people can trust public companies to report information on their finances accurately. And rotating of auditors was another one of those tools that they wanted to implement to ensure that auditors would not get so comfortable with their clients that they would do anything or do unscrupulous things. Internal control is really the backbone in this act, and what it does is it allows you to maintain a system of controls to protect assets, to make certain that information is processed accurately and you can rely on it, and finally to ensure compliance with laws. The truth of the matter is we as accountants and others who use financial information want to know that this information is accurate, that we can use it for our decisions, that we can trust that the information is purported correctly, that we can use it for whatever our purpose is. So this is just really for public companies, but it's important because most companies do follow the act, even though they may not be required. It is good practice to ensure that that you have a process in place. This act also requires companies to have a report and audit that report. What is called the internal controls over transactions. And it's very, very important that the transactions are prepared accurately and can be relied on. So the purpose is really, we're going to safeguard our assets. We're going to make certain that the information is accurate, and we want to make certain that the employees and managers comply with laws. It's simple as that. How we go about doing that could vary depending on what we're doing, what type of project or assignment is being performed. But in the end, the objectives are very, very clear, and they must be adhered to in order to have effective internal control. Employee fraud. We want to make certain that we have a mechanism to either prevent or catch. Now, no internal controls can prevent any type of fraud. Collusion is one of those things, and the Sarbanes-Oxley Act deals with it indirectly. Collusion is when more than one person is involved with this massive fraud or theft. Now, there are significant limitations in catching those individuals. Sometimes catching it just means you stumble onto it, and oftentimes that happens. But in the end, we want to have a reasonable assurance that we can discover if someone's trying to steal, and the type of things that can be done to avoid it or make it more difficult to do. Employee fraud is the intention of actually stealing something from an employer, whether it be money or some other asset. It could be theft of their trade secrets. It could very well be something like that, but in the end, it's theft. So the internal control elements include the environment, the risk assessment, the procedures, the monitoring, and the effective communication that they'll have. And we're going to talk about those. The environment is the attitude of management. Really, in the case of the Enron and the WorldCom type of scandals, the managers, the leaders of the organizations were involved. These thefts and lies and deception was not done by the everyday employees. These were upper level managers doing this type of thing. So it's clear that the attitude of management is going to make a difference. In this case, managers who are ensuring that they're going to do what's right and they're not going to tolerate theft by anyone. So the system can provide a reasonable assurance, and I told you that there is no way that you can possibly avoid any kind of theft in an organization. Your job really is going to be the truth. Do what you can do within cost-benefit analysis that can ensure that you can protect the assets, but you can't you can't um, mitigate for human mistakes. Sometimes people can circumvent it, and sometimes things are just too expensive to implement. So cost benefit has to be considered. Cash is going to be your coins, your paper money, your checks and your checkbooks, those kinds of things. It's going to be your money. It's going to be most likely somebody can steal it and actually gain access to your money. So control of cash receipts is going to really be important, because that's really what most people like to steal. I mean, it's not the easiest to steal, depending on the organization, but it's most likely going to be an area of vulnerability, significant vulnerability. And it's very important to control the cash. Who receives it, who posts the entries, having those duties separated. Again, segregation of duty is a critical part of any strong internal control structure. Having individuals doing separate duties and not allowing them to separate, to intermingle, will make certain that people can't steal, and it not only that can't steal, but they won't, the theft will be caught if it does happen. And that's really what's the most important. Sometimes you can't avoid people from stealing, but you can catch it. You can have a procedure in place to catch it, and we're going to talk about that as well. So, important to protect cash, and again, cash sales. A lot of organizations that are in retail deal with a tremendous amount of cash. And how do they maintain control of that? How do they keep employees from pickpocketing them a few dimes or a few quarters or a few dollar bills in their pocket? They do a lot of things. They can do audits. They could do have cameras in place. That's an internal control procedure. Having a camera to monitor people. It's not invasion of privacy. It is to ensure that people don't steal. And you can go to a Rutter store in Pennsylvania, in York County, Pennsylvania. You can see this particular store has cameras all over the store. You can go to a Walmart and you can see that there are a number of cameras. Very, very obvious. Some are not so obvious. But in the end, they want to protect not only the cash in the cash register, but also their inventory and their other product from theft. So that's a procedure. So how do you deal with errors and omissions? Reconciliation is the best way to catch mistakes. People are not perfect. And sometimes mistakes are made, general mistakes, not theft, not defrauding an organization, but an honest mistake. And we need to find those as well. Internal controls not only want to prevent or catch people from stealing, but they want to be able to prevent or catch errors, which is much more prevalent than actually stealing from an organization. If you look at everything in its totality, dealing with that is very important to consider. Sometimes mistakes are the reason why cash is short or cash is over. Somebody just made a mistake, a legitimate mistake, not necessarily trying to steal, not even attempting to steal, not even stealing. They just made a mistake in giving back the money back to a customer, or getting too much money back, or whatever the mistake is. But you want to have some kind of mechanism in place to ensure that if a mistake was made, particularly if it relates to cash, that it's caught and effectively dealt with. And again, these are just talking about different ways to deal with mistakes that occur, and an internal control will address that. Procedures, what do you do? How do you do this? Who does what? Who reviews? All of that. EFT is going to be electronic. This is one way that you can avoid people from stealing money that comes in from your customers or clients, making certain that everything goes from one bank to the other bank, and there's no human element whatsoever involved. Authorizing your payments to be received through an EFT, or paying your bills through an ACH. Again, bank-to-bank transactions, less likely for people to steal or have access to the information in order to gain your access to your accounts. And again, these are very, very cost-effective tools that most companies will most likely want to use. Why? Because people can pay quickly, easily, efficiently. It very enhances control over cash. It is most certainly a good way to avoid some errors. People can process payments wrong. People can make a mistake in processing your payment. So errors are less likely to occur. Again, all we want to do is to ensure that people who are making payments, that we can ensure that payments are made for authorized transactions, payments are received efficiently and are posted accurately. Money is not sitting around for days before going to the bank. Those kinds of things are very, very significant in any control system, internal control process. Timely deposits of money, timely reconciliation, frequent reconciliations, monitoring individuals, and then also the review and reporting of that information. Vouchering system is again a way to approve or to show documentation that process or payment has been approved. And that means number of individuals have reviewed the documentation, the invoices, the purchase order, or whatever type of authorization is necessary for this particular transaction to be processed. So it's a very good way to have a paper trail that follows the electronic trail to ensure that these two are in balance, that they are accurate, they are the same, is very, very important. Paying your bills through ACH or EFT is very important as well. Again, bank-to-bank transactions most likely will eliminate error and also make it very difficult because banks have extremely tight controls over monies going from one account to another. So again, you rely on not on your internal controls, but the enhanced internal controls of a banking institution. Again, protecting your resources, making certain that people don't have an easy way to steal money from you. And a bank statement is one way. Now remember, a bank statement comes after the fact. So a good internal control process is going to have steps and procedures prior to money leaving the door. However, on the back end, a bank reconciliation is another way to just make certain that you can get your bank statements, you review your bank statements, you check your transactions, you review them, and again, making certain that all the transactions are properly approved and recorded is also a big deal. But again, bank statements are useful, but they do give you information after the fact. So they are a way to double check to ensure that the accuracy of the information is reported in the books. So now when you're preparing a bank statement, obviously you're going to get the bank side of things, and then what you do when you're doing your reconciliations, you're going to make certain that your transactions match the transactions that the bank has and record any transactions that are not there, which could be bank fees or interest that are credited to, or any kinds of checks that your customers have paid to you and they may have been returned. So it allows you to see those transactions and record them appropriately. But again, it is a hindsight type of thing. These are transactions that already have occurred. So sometimes when you look at a bank statement, it's not a preventative measure. It's most certainly a measure to ensure that it is accurate and it is going on after the fact. So you have to have procedures in place to prevent. And bank reconciliation and reconciling it is not a prevention tool, but it is a way to catch errors or to verify that something inappropriate has occurred. So again, this is giving you these types of things that are going to hit your account that you have to make certain that they are recorded. Errors are also a possibility. They are rare, but they do occur, and reviewing your bank statement on a consistent basis is absolutely essential for strong internal controls. You have to make certain that you're verifying the transactions have occurred, everything has been recorded, because again, you don't want to have incomplete transactions on your financial statements because you will have understated balances. So it's very important to have the bank statement to verify and to make certain that all transactions, particularly those related to cash, have been recorded. And again, this is as I was talking about bank reconciliation. What does it do? It's just telling you what is the difference between what you have and what the bank has and determining what those differences are. Those are called reconciling items. And again, we all see in bank reconciliations because we've done them. We have our own personal account, and it's the same is true for any organization. The transactions may be different, but inflows and outflows are essentially the same. It comes with your bank balance and all the transactions that are deposits and withdrawals, and then the ending bank balance. And you are to take what the ending bank balance says and reconcile any differences between what your bank has and what you don't have. Record those differences to come up to the reconciled balance. And again, as you can see, the hard adjusted balances have to agree. Because what you're doing with the reconciliation is you're getting these two different numbers, my ending balance per my books and the ending balance per my bank, and getting them to agree. Basically, you are reconciling them. Petty cash fund is very, very important. And many organizations have petty cash funds. Again, petty is the key. Petty means small, minute, immaterial, very small. A petty cash fund with $5,000 in the cash box is not a petty cash fund, and that's very, very important. And that's one of the key factors in a strong internal control, having minimum cash available for expenses. Very, very small, very, very de minimis, and that's important for petty cash funds. They're very small. So these are things when you're paying for stamps, so you're paying for very, very small items, very, very immaterial dollar amount, no more than $50, that type of thing, because you're going to make sure that the things are paid, and if sometimes writing a check may take time, or write a check may very well be just overwhelmingly more than is needed. You don't want to write a check for replenishing your stamps. No, you probably do well to go to the petty cash fund. But again, making certain that the petty cash fund is small enough to meet those small needs and reconciled often. And often could very well be twice out of the month, depending on the regularity of its use. If it's not used as often, reconciling it once a month. But again, having a procedure in place, having a person who's responsible for sending the money out, and have another person responsible for actually the replenishment of that fund, meaning reconciling that fund, and have another person approve those transactions or those expenses. Again, having 3 different individuals involved in the process is a very, very strong control process for petty cash, particularly when the petty cash fund is very, very small. Again, I've worked with many companies who had a petty cash fund that was over $500. That's too much money. It's too much money to have one person being custody over. It's, again, the fraud triangle. You don't want to give people an environment for them to steal. You don't want to put them in that position that they could steal. And petty cash is a big area where many people, and I've experienced it in my career, have been guilty of stealing from the petty cash fund. Why? Because it's too large. 2, because people are not reviewing and overseeing it, reconciling it on a consistent basis. Again, internal controls require you to at least twice a month go through and reconcile your petty cash funds. Again, it's all about what's best for the organization and what's cost effective for them, but maintaining a small petty cash fund is probably the best idea. Again, cash equivalents are going to be things that are not necessarily cash, green currency, but they are almost exactly the same because the value of those numbers are not much different. And treasury bills is one, and money market funds are also another. So again, compensating balances is just a balance that you need to keep in your account, in your bank account, because you have some kind of loan. Doesn't happen very often, but some organizations have to have money in their bank account because they have a loan, and the loan requires them to maintain a minimum cash balance, and it can't be used. But it is important to have that disclosed in your financial statements, but it's also important to have it separate. Sometimes they have those amounts in a separate account on the general ledger to make certain that it's very, very clear and very obvious that these are the amounts that are not to be used, and this is going to be maintained. So again, analysis for decision making. Again, these ratios are very, very important when you're not only preparing your financial statements, but when you're actually trying to analyze it and compare it or contrast it with another organization. How can you maintain some level of cash on hand, and how does it compare with another organization? Very important information for internal controls. And I honestly think we all use internal controls in some measure on our personal level, but see how it affects the business side of things. And it will be interesting for you to note that businesses are very concerned about cash, as well as you and I, and the things that we do to protect our cash in some ways can be quite similar. I thank you very much for your time and listening, and I will talk to you in the next video.